Hello and welcome to this webcast with ViaCon Group, where CEO Stefan Nordström and CFO Phil Delborn will present a report for the third quarter of 2025. After the presentation, there will be a Q&A. So if you have any questions to the company, you can send them in via the form to the right. And with that said, I hand over the word to you, Stefan.
Thank you very much, Ludwig. This is Stefan Nordström, CEO of the ViaCon Group, and we follow as normal, or as usual, this agenda where I will briefly talk about Q3, but also what we see market-wise and outlook-wise market trends. Then Philip will take over and talk about the financials from Q3. And then, as usual, the Q&A, as Ludwig indicated. Starting with Q3 in brief, we have seen the strengthened earnings and margins, and the underlying EBITDA margin went up year over year from 9 to 10.1%. So that was a very positive development. This was also very much helped with a continued good cost control in the company compared to last year, coming from the big restructurings we did towards the end of 2024. So we can see a positive earnings development throughout the first three quarters of this year, even though we see that the market conditions are not yet fully ideal and not yet back to normal levels. So again, thanks to the good cost control, but also the margins we have on each of the projects that we sell. When we look at revenues, they are clearly in line with previous year. So the unchanged revenue, meaning not the revenue growth we wanted to see, is due to delays or continued delays in the decision-making processes for infrastructure projects across the European markets where we are active. And specifically in Poland, this has been the case. But now a new law is expected to be passed by the end of 2025 that will significantly accelerate the approval processes for new projects. So the market can get going again. During Q3, a lot happened with our balance sheet and our financing. So first of all, at the end of July, the divestment of our facility in France was completed, and that generated a cash injection of 9 million euros. We are underway with a similar process in the UK, and we expect to close this before the end of this year. Also, the amendments to the bond were approved, and that entails an extension of the final repayment by 30 months. So that runs now until the beginning of May 2028. There was also a shareholder contribution during Q3. The revolving credit facility was also extended to 2028. And all these changes were implemented and operational during October of this year. So very much strengthened balance sheet and thereby liquidity situation in the company. And we hope more to come with the divestment of the UK facility as well. Looking at the market and what we see in the near term going forward. First of all, we have seen that the market activity has improved and recovered during 2025 compared to last year. But the market or markets actually all over the place in Europe are not back to normal levels yet. And we don't expect them to be by the end of 2025. However, we are seeing a very clear trend across many markets in Europe where large-scale infrastructure projects are being planned, both for the short and for the long term. But these initiatives, they take time. They need to go through complex permitting and decision-making processes. And this means that so far we have seen only a very limited impact within our areas of operation. Specifically then in Poland, repeating what I said before, this new law is called Specustawa, is expected to be passed by the end of this year. And this will then significantly accelerate the approval processes of new infrastructure projects. And this is a very important and crucial measure to enable the whole infrastructure business in Poland to make use of the substantial funds from EU that are allocated to Poland. So with this as a background, we can expect that the overall infrastructure market in Europe will start to wake up during 2026 and stay quite positive for probably several years beyond 2026. But we haven't seen the evidence yet. The activity in the markets in terms of pipeline, etc., is good, but delayed decision making. But we are quite hopeful looking ahead. With that said, I hand over to Philip for the financials.
Thank you, Stefan. And if we look at the group summary first for the third quarter, it was a quite stable quarter with strength and margins, as Stefan mentioned. The organic growth in sales was 2% in Q3. And the reason for the somewhat lower organic growth in the quarter is partly this delay in the approval processes that we mentioned previously. If we look at the EBITDA, we had an EBITDA of 4.6 million in Q3, which was higher than the previous year. And the main driver behind this is the good cost control that we continue to see across the group. If we look at the organic growth in order intake in the quarter, it was minus 6.7%. And the expectation is that the order intake growth will accelerate in line with these big infrastructure investments that are being planned across Europe. And this will have a both medium and long-term effect on our organic growth in the order intake. If we then go into the three business units and we start with bridges and culverts, here we see a nice organic growth in sales at 10.6%. And in terms of top line, the majority of the business units' geographical regions developed positively during Q3. When we look at the margins, we can see a decline, and that is mainly due to a favorable geographical mix. We have different margins in the different countries, and the mix of the countries impacts the overall margins for bridges and culverts in the quarter. If we look at the organic growth in order intake, it was minus 12.5% in Q3. And it's these delays in the approval processes that we can see has a negative effect on our order intake in bridges and culverts in Q3. If we then have a look at our second business unit, GeoTechnical Solutions, we have an improved earnings in the Q3 despite the lower sales. The organic growth in sales was minus 8.4%. And this drop in sales is mainly isolated to a few core markets in GeoTechnical Solutions. We see a slight improvement in the EBITDA, and that's a consequence of the cost and efficiency measures that was implemented in the fourth quarter of 2024. However, looking at the organic growth in order intake, we have a positive development. It's plus 10.9% in the third quarter. Then our final business unit, that's StormWater Solutions. Here we can see an increase in both sales and earnings and an organic growth in sales of 6.2%. And this growth is spread across several geographical markets, which is positive, of course. The increase in EBITDA is linked to the improved top line, but also to the continued good cost control also in this business unit. If we look at the organic intake, we have a negative growth of 16% in the quarter, and that is mainly related to how the larger projects fluctuate between the quarters. And we can see a negative impact from that in the third quarter. So that was the three business units. If we then take a look at the cash flow and the financial position of the third quarter, we have cash flow from operating activities of 0.6 million compared to minus 0.9 million in the quarter last year. The effect from change in working capital was positive 1.4 million compared to a negative 0.4 million in the third quarter last year. And the main driver behind the cash flow is the positive impact from EBITDA improvement and also the improved working capital. In terms of CapEx, a quite low level, only 0.4 million in the quarter compared to 1 million a year ago. And if we look at the net cash flow for the quarter, we have a positive effect from the divestment of the property in France of approximately 9.5 million in Q3. Our net debt by the end of the quarter was 108.4 million compared to 107 million a year ago. And our cash position in terms of cash and cash equivalents was 14 million. And that includes our drawn RCF or revolving credit facility of 10 million, which was drawn at 15 million a year ago. And then, as Stefan mentioned initially, we had the proposed amendments of the bond approved in the quarter, and which also includes this extension of the final repayment date until May 28th. And also shareholder contribution, which strengthened our balance sheet. And in addition, we also secured an extension of our revolving credit facility until February 28th. These changes will be visible in the next upcoming quarterly report. They were implemented in October 25. So that was it in terms of the financials.
Very good. Then, Ludwig, I think we can open up for any questions, and we will try to answer.
Yes, thank you so much for the presentation here. And the first question here is, what drives the strong margin improvement in this quarter, and how sustainable is it?
It's very much supported by the good cost reductions and the restructurings we did towards the end of last year. That's the main contribution to the EBITDA margin. And we have no plans in dramatically increasing our OPEX spend going forward. Then, of course, there are always inflationary pressures in the different countries where we have to adapt. But over and above, we are planning to maintain around the same levels as we have experienced so far this year.
Thank you. When do you expect order intake to recover, especially in key markets like Poland?
I wish I knew in detail myself. We are waiting for this, but there has been like a pent-up demand in several markets in Europe for the last 2 years, I would say, 24 and 25. And that has caused a high burden on many authorities across different countries in Europe. And that causes delays in itself. Now, for instance, if we talk about Poland, which is one of the important markets for us, the restart of the EU funds made available in the spring of 24 following the new government in Poland has also caused a lot of planning for new infrastructure developments. And this has created an even higher burden on the authorities in Poland. But then we have this law that I mentioned. It's called Specustawa, which is expected to be passed by the end of 25. That should significantly reduce the timeline for approval of new projects. So yes, I wish I knew, but the activity in the market is quite high, and we do expect this to see a trend shift on the order intake getting into 2026. But it's very hard to say exactly when that will happen.
Thank you. How will the extended bond maturity and credit facility strengthen your growth outlook?
It's of course nice to have a stronger balance sheet, and it enables us to continue to focus on the opportunities that we see in the market. As we mentioned, there is a lot of infrastructure investments going to be released around Europe the coming years, and of course we want to take part of that journey. So with a stronger balance sheet, it enables us further to be present where all these opportunities pops up the coming quarters and years here. So that is, I would say, one of the main benefits from a stronger balance sheet.
And to prepare for an expected growth from 26 and beyond, we have also targeted certain geographies and product segments around in Europe, and strengthening our sales and technical teams to be ready to take care of the expected growth. Still, we are managing the total OPEX around the same level as we have seen during this year so far. So we are preparing, and the liquidity allows us to make such investments in the company now. This is very good for us and positions us very well for good growth when that comes.
Thank you. Moving on to the last question here. What are your priority areas for capital allocation over the next 12 months?
I don't think we go into details of where we allocate resources, but there are certain specific areas. Again, I'm repeating what I said on the previous question, where we see good growth opportunities, and this is where we will prioritize growth and take care of the opportunities. So we are in the starting blocks and ready to take care of this.
Thank you, and thank you so much, Stefan and Phil, for presenting here today, and thank you all for tuning in. I wish you a pleasant week.
Thank you very much.